At 6:42 in the morning, you are standing in a windowless green room with half a bagel, a paper coffee cup leaking through its seam, and a financial news alert calling you a billionaire. Your name is Elena Alvarez. Most people call you Lena. You are 35, and the company you built will begin trading in less than 2 hours. You own 21.5 million shares of Northline Signal. At the $52 IPO price, your founder's stake carries an implied market value of $1,118 million. For 8 years, you imagined that number would feel like every locked door opening at once. Instead, you ask your CFO an ordinary question. How much of the offering reaches my account today? Aisha Rahman slides the final offering sheet across the table. None of it. Northline is issuing 12 million new shares at $52 each. The company will raise $624 million in gross primary proceeds before underwriting costs and offering expenses. You are selling 0 shares. The money belongs to Northline's corporate treasury. It can fund hiring, research, customer deployments, and operating reserves. It is not your personal checking account. The billion beside your name is not a wire waiting to clear. It is a market price multiplied by one concentrated block of stock. Your fictional IPO agreement also includes a 180-day contractual lockup. After that, securities law, company policy, and your position as CEO will still govern any sale. On paper, you have just crossed one of the most famous wealth thresholds in the world. In cash, nothing has arrived. Outside, someone tests the opening bell microphone. Theo Grant, your co-founder, paces between 2 folding chairs. Beneath the offering sheet, the black elastic band of your old orange field notebook is still visible. Northline Signal and its people are fictional composites. The financial contradiction is real. A company can raise hundreds of millions in an IPO while its founder receives no personal proceeds. The number will still change everything, just not in the way you expected. 8 years earlier, there was no stock quote, no board committee, and no reporter waiting outside a green room. There was a transformer test yard in Minnesota, winter wind moving across the concrete, and the orange notebook in your work jacket pocket. You were 27, earning $104,000 a year as a grid reliability engineer in Minneapolis. You studied failure patterns in electrical equipment so utilities could identify problems earlier. But the reporting systems emphasized patterns people already knew. You kept noticing exceptions. 2 transformers could look similar in a standard report while temperature history, loading, and maintenance suggested different risk. You drew curves by hand and marked failures that became obvious only after a field visit. That notebook did not contain a billion-dollar idea. It contained a problem you could explain clearly enough to test. At the time, you had $58,500 across cash, a 401k, and your car. You owed $28,800 on student and auto loans. Net worth, $29,700. You did not quit the next morning and call courage a business plan. For months, you developed the model outside work, tested a narrow pilot, listened when utility engineers explained where it failed, and built personal runway. Only after committed seed funding existed did you leave your job and incorporate Northline in 2019. Theo understood field operations and utility procurement better than you did. Early employees accepted salaries plus equity. Investors supplied capital because deployments required cash before contracts produced recurring revenue. Every round changed your ownership. At first, you owned most of something with no reliable market price. Later, you owned less of a company with customers, employees, outside directors, and valuable technology. You exchanged part of your economic ownership for capital, talent, an employee option pool, and more time to build. The percentage went down. The organization grew. Your responsibility expanded faster than either number. In 2023, a board-approved secondary transaction let you sell a limited amount of existing stock and create some personal liquidity. By the IPO eve, your balance sheet outside Northline stock held $740,000 in cash and short-term treasuries, $910,000 in a diversified brokerage account, $265,000 in retirement accounts, and about $560,000 in home equity. Net worth outside the company stock, approximately $2,475,000. You were already financially secure. You were not already carrying $1 billion in liquid wealth. That distinction would become harder to explain once the public market supplied a price anyone could multiply. During IPO week, Aisha drew 3 columns on a whiteboard. At the top of the first, she wrote company cash. At the top of the second, personal liquid assets. At the top of the third, founder stock at market price. People will collapse these into one number, she said. We can't. The first column held the $624 million in gross primary proceeds from Northline's new shares. It would enter the corporation before offering costs and could support product development, customer installations, payroll, or reserves. You controlled important decisions as CEO and director. You did not personally own the corporate bank account. The second column held personal assets, cash, short-term treasuries, your brokerage account, retirement accounts with their own rules, and home equity that was valuable but not checking account money. They were worth far less than the headline, but were less dependent on Northline's price. The third column was the one that made the news. 21.5 million founder shares at $52 each produced an implied value of $1,118 million. Add the estimated $2,475,000 outside the stock, and the rough IPO day calculation put your gross estimated net worth at $1,120,475,000. The arithmetic was valid. The interpretation could still be wrong. That did not mean every share could be sold immediately at $52. Your contractual lockup prohibited sales for the period specified in Northline's offering documents. As a founder, officer, director, and large shareholder, public resale also remained subject to applicable requirements, company policy, and compliance review. The end of a lockup would remove one contractual barrier. It would not turn your brokerage account into a button you could press whenever a headline made you nervous. Nearly all the spectacular part of your net worth depended on one company, the same company that paid your salary, occupied your attention, carried your reputation, and employed people you had recruited. If Northline performed well, the same exposure could create enormous upside. If it performed poorly, there was no unrelated asset inside that billion-dollar figure to soften the decline. That was concentration risk. The asset was economically real and still left you dependent on one source of value. The screen did not show that dependence. It displayed one clean number. It also did not show a tax bill. A higher quote was not a completed sale. Basis, holding period, transaction type, and other facts would matter when a taxable event occurred. Valuation was not liquidity. Company capital was not personal capital. And a public price was not a promise. On the morning of the IPO, you understood all 3 sentences intellectually. Emotionally, you still wanted the price to tell you that every sacrifice had been worth it. Northline opened above the offering price. For a few weeks, the market made the story larger. At $58 per share, your 21.5 million shares carried a quoted value of $1,247 million. You had not created new sensors that morning. Customer retention had not improved between breakfast and lunch. Yet the quoted value of your stake had risen by $129 million from the IPO price. Interview requests multiplied. People who once asked about transformer degradation now asked what it felt like to be a billionaire at 35. Employees took photos. Relatives sent links. Vendors returned calls faster. The number created attention before liquidity. Nia Brooks, employee number 14, did not ask what you planned to buy. She waited until the celebration thinned out, then found you beside a conference room window. Can I ask you something without sounding ungrateful? Please. If the shares trade at 58, does that mean our options are worth that? You could have given her the exciting answer. Instead, you gave her the accurate one. An employee option was not a founder common share, and neither one was cash. Vesting, the exercise price, taxes, the ability to sell, and the future market price all mattered. It might become meaningful money, you told her. But the quote is not a guaranteed payout. Nia nodded, disappointed but not surprised. The conversation stayed with you. You wanted Nia to treat the quote as uncertain while treating your own billion-dollar calculation as proof. Then a large customer delayed a renewal. Broader growth stocks weakened. Analysts began questioning whether Northline could expand as quickly as management had projected. The share price moved below 52. Then below 40. Nothing inside your house changed. The mortgage payment did not fall. Northline's payroll was still due Friday, and the money it raised still belonged to the company. But every downward tick felt like a public vote on the 8 years behind you. 5 months after the IPO, before the contractual lockup had ended, you reached for your phone while your first coffee was still brewing. The price no longer began with a 5. It no longer began with a 4. It began with a 2. Aisha was already calling. Aisha did not begin with hello. $29. You stood beside the kitchen counter and watched the coffee move through the machine. At the IPO price, your 21.5 million shares had carried an implied market value of $1,118 million. At $29 a share, the same block was worth $623,500,000. The quoted value had fallen by $494,500,000. You had not spent it. You had not sold a share. There was no $500 million transfer leaving an account. This was a mark-to-market decline, the public market applying a lower price to the same concentrated position. The distinction mattered. It did not make the screen easier to look at. Your mortgage was unchanged. Northline's payroll was still due. Customers still expected deployments to work. The contractual lockup had not yet ended, and even when it did, your position as CEO, director, and control shareholder would still matter. The market had changed its estimate of your wealth. It had not released you from a single obligation. I feel ridiculous, you said. Aisha was quiet for a moment. The market took away a title, she said. It did not take away the job. You had told Nia not to treat a stock quote as a guaranteed payout. Then you had treated the same quote as a verdict on whether 8 years of your life had been worth it. The orange notebook sat inside your work bag, untouched beneath 2 board packets. It held hand-drawn evidence from before anyone could price the company by the second. You thought about the question that had followed you since the green room. What does the number let you do? You could not move company money into your own account. You could not sell locked shares because the price frightened you. You could not promise employees that the quote would recover. And you could not make Northline more credible by needing the market to validate you every morning. The billionaire label had made you feel powerful. Losing it showed you how much power you had quietly given the label. You did not become poor at $29. You still had substantial assets outside the company and a founder stake worth hundreds of millions on paper. But the humiliation was real because the number had been doing emotional work it was never built to do. By the end of the call, you stopped asking how to get the billion back. You asked Aisha a different question. How do I keep my personal plan from becoming a reaction to this screen? You were asking how to make one part of your life less dependent on the market's next answer. The answer did not begin with a sale. It began with silence. Theo wanted you to send an all-company message saying Northline's long-term story had not changed. The sentence was probably true in spirit. It was also broader than the data allowed you to prove. Nia wanted a different kind of clarity. Do customers understand what the model can't see in extreme heat? She asked. She did not mention her options. She did not ask when the stock would recover. She asked whether the people relying on Northline had enough information. As a public company CEO, every confident sentence could be interpreted as a signal. Optimism could move expectations. Silence could do the same. Daniel Cho, the independent board chair, made you document alternatives instead of treating conviction as evidence. Later, during a permitted adoption window, after counsel and company compliance confirmed you were not acting while aware of material non-public information, you established a Rule 10b-5-1 trading arrangement with predetermined conditions. The arrangement did not guarantee a good price. It did not create immunity from insider trading law. It did not allow you to react to every bad morning. That was the point. The applicable cooling-off period had to pass. The first scheduled transaction would occur because the plan's conditions were met, not because you liked the quote that day. When it finally happened, 80,000 shares sold at $30.80. Gross proceeds, $2,464,000. That was before taxes, basis, transaction costs, and the rest of the facts that determine what a sale actually leaves behind. It was also only about 0.372% of the 21.5 million shares you had owned at the IPO. For the first time after going public, a small part of the founder stake became personal liquidity. The wire was real. The billion had never been liquid. The sale did not remove concentration risk. More than 21.4 million Northline shares remained. But the sale separated a personal financial decision from the need to predict tomorrow's price. Then, one Thursday afternoon, Nia sent a message with no greeting. We need the orange notebook. Page 73. The next decision would not ask whether you could turn shares into cash. It would ask whether you could approve spending company cash in a way that might reduce the value of every share you kept. The curve on page 73 was drawn 8 years earlier. At the transformer test yard, you had marked a pattern that standard reporting had treated as noise. Under a narrow set of extreme heat conditions, equipment with similar surface readings could be degrading at different rates. Now Nia's validation team had found a related weakness in Northline's model. There was no cinematic catastrophe. Under specific extreme heat conditions, the model might understate transformer degradation risk for a subset of deployed systems. The probability range was still being tested. The risk was credible enough that pretending not to see it had become a decision. In the boardroom, the orange notebook lay open beside the validation report. Theo argued for a staged response. Pause only the highest risk configurations. Continue unaffected expansion. Patch the model while field teams gathered more data. He was trying to protect employees, customer relationships, and a company that could be damaged by a warning broader than the evidence. Daniel asked for the cost of both paths. A full affected deployment pause, customer notification, field support, independent validation, and remediation reserve would require approximately $42 million of company funds. It would also delay expansion. No one in the room could calculate the stock reaction honestly. You looked at the page that had existed before the ticker. You still own 21.42 million shares. Every $1 move in Northline's price changed the quoted value of that stake by more than $21 million. Protecting the price could protect your personal mark-to-market wealth. Protecting customers could reduce it. Daniel turned toward you. What is your recommendation? This was the level of ownership the IPO headline had concealed, the obligation to choose while your own interest was inside the equation. You recommended a narrowly scoped disclosure, a pause for the affected deployments, direct customer support, independent validation, and the full $42 million remediation reserve. Not because uncertainty had disappeared. Because it had not. The company had asked utilities to rely on its judgment. That made credible uncertainty part of the product. Northline announced the review and remediation plan. Customers called. Analysts revised models. The stock later traded near $24 amid the disclosure and broader uncertainty. After the scheduled sale, your remaining 21.42 million shares carried an implied value of $514,080,000. That price did not prove the board's decision was correct. A recovery would not have proved it either. The market could remove the title before lunch. It could not make the decision waiting on page 73. You were no longer a billionaire by the price used in the story. You were still the engineer who had written down a pattern because ignoring it would have made the report cleaner and the system less honest. The billion had been a price attached to your shares. The responsibility was attached to your name. Months later, you returned to the transformer test yard in a charcoal work jacket. The wind moved across the concrete the same way it had when you were 27. The orange notebook was open on a metal table, page 73 beside a new independent validation report. Nia stood across from you. Do you miss it? She asked. The number? She nodded. You did not pretend money was meaningless. Seeing 1 billion beside your name had been satisfying. The liquidity plan still mattered. You still owned hundreds of millions in concentrated equity, and Northline still had to earn the trust implied by every deployment. But the number had never been cash. It had been a public price attached to one asset, at one moment, before taxes, restrictions, and the obligations ownership carried. At 35, becoming a billionaire had not removed uncertainty. It had made your relationship with uncertainty public. You closed the validation report, then the orange notebook. In the green room, the notebook had been hidden beneath an offering sheet while the market decided what your shares were worth. Here, there was no stock price screen. Only the old curve, the new evidence, and a system people needed to trust. You pulled the black elastic band around the notebook and placed it in your jacket pocket. The number had told the world what your ownership might be worth. Page 73 had reminded you what the ownership was for.